straight into life insurance. So I think it's best for me to just be able to define some terms for us so that as I continue, at least you'll know what I'm talking about. So first and foremost, insurance. I'm pretty sure we've all had concerning insurance in one way or the other. We've seen some insurance companies in Kenya, like Jeruth working for Madison, me working for Britam Insurance Company. There are quite a lot of insurance companies in Kenya. And so just to define insurance, insurance is a contract between the insurance company, which in other words we call the insurer, and the insured. The insured is the one who is being protected by the insurance company. That guarantees that the insurance company will be able to pay an amount of money to the insured. The insured, remember I've said, is the one who is being protected, the one who takes that life, that's insurance, in case of an unforeseen event or if a risk occurs. And in this case, now since we are talking about life insurance, now we are going to base this definition of ours into life. So life, when a life is concerned, there has to be a person, there has to be an individual, and this is the one that we call now the assured, or rather the insured person, who is now who approaches now the insurance company and tells them, I need protection, and this is the amount of money I'm going to be paying, probably on a monthly basis, for me to be able to be protected against, we protect against death, in case of unforeseen death, or rather premature death of the assured, or in case of disability of the assured, or in case of critical illness of the assured. And now, in this case, you see here now the insurance company now comes in. We as the insurance company, we come in and we protect you against these three instances. And this means that upon entry, or rather upon taking this life insurance or life assurance, we guarantee that there's this amount of money that we as the insurance company will be paying you, as long as you keep paying your monthly contributions. These monthly contributions are called premiums. In the insurance industry, we call them premiums. And so we have three types of life insurance. We have term life, we have whole life, and we have endowment life insurance. Just to give a brief description, or rather explanation on what the three of them are, is that term life is the type of life insurance that guarantees payment of a stated death benefit if the covered person dies during a specified term. This means that you as an individual, if you're in need, which is very important, if you want to purchase this term life, what really it means when someone is purchasing a term life insurance, it means that you are approaching the insurance company with a view of you want to be protected for this amount of years, maybe let's say like 20 years, against death. And if death does not occur within these 20 years, this term life, or rather this life policy, it ends. This term life, in short, it means that we as the insurance company, we are protecting you as the client. If maybe you are foreseen, God forbid, you're foreseen maybe your children are going if your children maybe are going to, or you as an individual, and you're the main breadwinner in your family, and maybe you see that there's something that you really need to protect yourself against death. This term life protects against death only. So in 20 years, you've maybe approximated and said, I want a term life of 20 years covering me for 20 years. If death does not occur within the 20 years that you've taken, so this the term life contract, the term life policy ends. This is majorly a protection kind of life insurance. Protection. It measures mainly on protecting you as the client. So if death does not occur, there's no payment that is made. And also another thing, the assured, now you who is the individual, the client who has taken this term life, does not usually receive return of payment. because the main emphasis here was just to offer you protection against death. So in case death would have happened, God forbid, now we as the insurance company, we come and we pay the death benefits to the beneficiaries that you would have stated. Beneficiaries are people you state upon entering the life insurance, upon taking the life insurance, that you're authorizing us as an insurance company, maybe in this case as Britain, you're telling us, I want my parent to, in case something were to happen to me, I want my parents, or I want my spouse, or I want my child, blah, blah, blah. Those are the beneficiaries. Those who will suffer when, upon the demise of the client. So the second life insurance is whole life. Whole life is usually taken, is a type of life insurance that provides permanent death benefit coverage for the life of the assured. This is, you're taking it for your whole life, so you can continually pay premiums all throughout your life. And then when death occurs, that is when we as the insurance company, we come in now and we pay your beneficiaries either periodically, maybe like up to like certain maybe we pay as or rather we compensate as monthly income for the beneficiaries, or we pay lump sum, depending on how much you as the individual would have wanted. Let's say, let me just use this example. When you are purchasing this whole life, at the beginning you said, in case something were to happen to you, you want your family to be paid 10 million. So now, if this happens and you've been covered for whole life, and maybe it happens, this unforeseen death happens at age 70. So we as the insurance company, in this case Britam, will come and pay your beneficiaries, or rather compensate your beneficiaries the 10 million that you had saved upon. Hadi hapo tuko sawa? Are we okay?
We're good. I just received a question.
Yes.
What we've just covered, mtu alikuwa anauliza, now when the term ikiisha, pesa unarudishiwa ama inaenda hivyo? For instance, time ikiisha kama you're still alive.
So there are three. Let me just finish with the last one, and then you'll be able, I think I will go back to that question, because the first nini I covered is term life. This term life is purposely taken to provide protection against the client in case of death. So if death does not occur, there's nothing that is paid. However, the third life insurance is called endowment. Now, for endowment, you take this as a client for a specific period of time. Example, like 5 years, 8 years, or 10 years, or 9 or 15 years, or 20 years. It depends with your need at that particular moment. And so this endowment life policy, it pays you either on death within the period, or if not death, it pays you the agreed amount at the end of the term. Let me do an example. Client A comes and tells me, Mercy, I want an endowment policy. And this endowment policy, I want its policy term, or rather the fixed years, to be 15 years. And this client is so healthy, nothing happens to the client, and the client after 15 years does not die. So this client, because he or she has taken the endowment policy, at the end of the term, the 15 years, this client was taking a life cover of, say, example, like 10 million, or rather 5 million, or any amount, 2 million, 1 million. And so 1 million, we can just work with around 2 million. 2 million for 15 years, right? So if at the end of the 15 years, the client doesn't die and proceeds on living very healthy, we still will pay the agreed amount in the beginning, that is the 2 million. And also the endowment also pays in case death happens as well within that period. We as the insurance company will still pay now the beneficiaries the 2 million. So when we are taking, or rather when we as individuals are approaching insurance companies in the name of we want to take life insurance, it's very important for us to understand these three classes of insurance, so that you do not end up finding yourself taking a term life, which I earlier stated that it is purely for protection, and then maybe at the end of the term, nothing happens to you, and you say like you get disappointed because there's nothing in return. So that is why I have explained the three of them. So upon you taking the insurance company, you should be able to know now if this is an endowment policy. Endowment policy now is the one that is so common in most of our insurance companies, that provides protection regardless of whether there is death or whether there is, like, upon maturity, like at the end of the term. That is what I mean. So something else to note about endowment life insurance. It's usually a savings. It's designed in a way that you can still save. You're act not you can still save. You're actually saving as the years progresses. Back to an example of 15 years of this client A, who has taken this endowment policy for 15 years and wants to get to be compensated in case of either death or disability or critical illness, around 2 million or 5 million. So this client A will be paying premiums, those are monthly contributions, every day for the next 15 years. So in this way, this is actually a very good instrument of saving, because it also gives you the discipline, because you know every month you have to deposit this amount of money, so that in case something were to happen to a client, God forbid, your dependents, or rather your beneficiaries, will not struggle. Or rather, even you as maybe a client, if God forbid again, if disability happens, and then maybe for instance, the pilots, they majorly use their eyesight and maybe their hands, and God forbid such an instant happens and an accident happens and the pilot is disabled. Now, if this pilot had taken this kind of life insurance, you see, there is maybe at that particular moment, this client cannot be able to continue being a pilot. And so this life insurance now comes and takes care of him himself and also his beneficiaries, because he has been paying premiums. He has this protection, like this life insurance is like an umbrella to himself and to his family, so that his family does not go back so low, because this person was the main breadwinner of the family. It also provides for protection and investment, just as I have said, because as you are continuing saving, these premiums that every client gives, or rather pays to the insurance company, we then go ahead and invest these premiums, and then so you find at the end of the term, there's something that has been added on top of your normal monthly contributions. In this case, like in the layman's language, you say like interest has been accrued. So another thing that I want to ask us to talk about: why do you need life insurance? Why do we all need life insurance? Number one, life insurance is the cheapest way of protecting your loved ones, regardless of what stage of life you are in. If you have a spouse, if you have a if you have children, even if you're a single person and you have siblings who maybe depend on you, if you're the breadwinner of your family, it is still a way of protecting your loved ones. And then it helps you build capital while having protection at the same time. I have said that when you consistently pay your premiums, your savings build up capital over time, and at the same time you're being protected. So another thing is, it's a sure way of being disciplined in savings, and then because you're making the constant premium payment, and also there's also another factor that you can take a loan against your policy, and that is what happens in the life insurance. And also in our case in Britain, when you take the life insurance after 3 years of your policy being in effect, your life policy being in effect, you can take up a loan. We do not need guarantors, we do not need title deeds or whatnot, those things that sometimes banks ask for. Because you are a client, we've seen you paying your premiums faithfully for the 3 years, and so you can take up a loan after that point. And then you can go do your things, and then you pay up. So, and then life insurance also, I have said also, it has two aspects, both protection and investment. Please let us not forget this. Life insurance has both protection and investment. At the same time, you're you as an individual, you're being protected, your children are being protected, your parents are being protected, your spouse is being protected. At the same time, your investments are growing. Like, it's also an investment tool for you. Okay, so something also to note, the younger you are, the cheaper it is for you as you're purchasing the life insurance. We usually have factors that we consider in the insurance industry that determine how much an individual is going to be paying the premiums. Because, and one example, one of these factor is age. So, the middle-aged people, or rather middle-aged clients, are are categorized differently compared to the older age clients. Example, these are the older age. I'm talking maybe about 50 years of age, 60 years of age. So the premium, the factors that will determine how much the 70-year-old will be able to pay with the 18-year, or rather the 20-year, or the 30-year-old, is totally different, because at 30 years we know, or rather we perceive that this 30-year-old person is very energetic, can do the work properly. Like, this young person has a lot of strength, so his exposure to risks in terms of health issues, there are those health issues that come when someone is of old age, maybe, I don't know, heart diseases and all that. So the younger people are not considered to be highly exposed to such conditions. And here, the 70-year-old client, chances are, if that person is not careful on how the person lives, I mean, the lifestyle, what he eats, what he drinks, maybe his exercising habits and all that, you'll find out that the 70-year-old person is highly exposed to old age diseases. So now, that is why I was saying that the younger you are, the cheaper it is for you to obtain this life policy. And then also, another thing to note, please take a policy that you'll be able to pay till maturity. I think it's also important for us to realize and to basically be able to be comfortable in being able to pay premiums in accordance to your financial capability at that particular point. And then the good thing with this, as you progress, your financial stability increases, you're not limited to how many life policies you can take. Because at the end of the day, you're looking at you yourself having been protected, and at the same time, you're also growing your investments. And then lastly, general uses of life insurance policies. I'll just go through them because I mentioned and explained hapo mbeleni. We have family protection, just as I was saying, that if you take the life policy, your family is guaranteed of protection in case of death, God forbid, in case of disability, God forbid, in case of critical illness. Again, financial planning, it helps you to plan yourself well, because you know that this I'm contributing this amount against my policy, and this is what I will get at the end of the policy term. And then also retirement planning. There are other life insurance that have that mature upon retirement of an individual, which is actually very good. Yeah. And then also the aspect of savings, the aspect of education. If you have a child, or if you know someone who has a child, it's very important for us to begin saving towards the education of our children. Again, another thing, this is one thing I've really come to appreciate in my line of dealing with life insurance and clients. I have clients who, yes, they do not have children at this particular point of time, but because of how the education policies are structured, they feel comfortable in taking the education policies, because at the end of the day, this our what is it called, our contract is between us and the state person, even if the person is single. Because at the end of the term, if it's the 12-year term or the 15-year term, we pay this sum assured, the full value of the insurance, to the said person. We do not go and pay it to the school. And this also happens to parents who have children. At the end of the policy term, if they're taking this education policy, we pay it directly to the account of the parents, not to the account of the school. So at that particular point, the parent is able to know how to pay the school fees for the child. And then last but not least, there's usually tax planning. For policies, life insurance policies that are more than 10 years, there's usually a tax-free on those life policies, because the government is engaging, or rather is encouraging people to in Kenya to save more on the no, more through the life insurance. So your maturity, or rather your sum assured, or rather the final value comes to you, it is coming as tax free. Thank you. That is what I had.